Welcome back. Finally, we are going to look at the gold US dollar forex pair. It's one of the premium and most traded commodity currencies in the market. The gold dollar is measured as the price of gold in terms of dollars. A contract is quoted in dollars per troy ounce, and it represents 100 troy ounces. Gold, historically, for many decades, has been seen as a safe haven asset. Why? Because in terms of economic uncertainty or volatility, the general public, investors, people that are just normal like you and me, we rush to gold because it's a real asset and it has always been highly valued since ancient times. So we see gold as one, a store of value, and two, a hedge against inflation. For traders that like low spreads, you can trade gold, the gold dollar pair, because it is one of the most traded assets in the markets. There are a number of factors that affect the price of gold. The first being inflation. When inflation is on the rise, this proves to be a bullish indicator for the price of gold. Remember, gold is seen as a hedge against inflation. So its price is the demand for gold is going to increase, which will also increase its price. Currently, right now, many countries around the world, including Nigeria, is experiencing high inflation. Even the US is far from the 2% inflation target. As of July this year, the US has experienced inflation of 8.6%, the highest it's been in 40 years. And since 2022, last year, they have been raising interest rates in order to bring down this inflation. But we are uncertain when this policy is going to bring down inflation. And therefore, be on the lookout for the first signs of inflation coming down, because that's going to affect the price of gold. The next factor is interest rates. If interest rates are rising, this is a bearish indicator for the price of gold. Why? Because gold, as seen as an asset, as seen as an investment, doesn't return as high as other risky investments like bonds or stocks. So therefore, when interest rates rise, gold is going to look like a very unattractive investment, therefore bringing down the demand for gold and its price. Then we have unemployment. When unemployment is on the rise, however, that means that things are looking shaky in the economy. And therefore, when things are uncertain, the price of gold increases because people are rushing to it as a safe haven asset that it is. Next, we have geopolitical events. In times of war, or when there's a lot of terrorism happening, a lot of disputes among countries, the markets are afraid. People are uncertain about the outlook of the world. This is the time that gold is seen as a safe haven asset, and therefore its price is going to be bullish. According to ABN AMRO Bank, in the weeks leading up to the Russia-Ukraine war, the price of gold was bouncing higher and higher. Even on March 8th, 2022, the price of gold reached its 14-month high of $2,051 as Russia invaded Ukraine. Yes, the price of gold has come down from its historical high since the first weeks of the invasion, but it still remains higher than pre-war levels, hovering around $1,800 as of July 19th, 2023. Next, we have supply and demand as a factor that affects the price of gold. When there is a shortage in production, then that means that this is a bullish outlook for gold. For instance, in 2022, the amount of gold mined was around 3,612 tons. But production is expected to reduce in the next coming years because it is becoming increasingly less economically viable to mine gold as the cost of production increases. Then the demand for gold is based off of a few factors, namely, one, the increasing use of gold in our electronics, and two, its attractiveness as an investment asset. Things are getting more dicey in the world. We're hoping that the US-China trade war will soon close. We're hoping to a peaceful resolution of the Russia-Ukraine war, and so many other global events that we are watching and being on the lookout for. So these are the factors that affect the price of gold: inflation, unemployment rates, interest rates, global events, and supply and demand. In conclusion, we have walked you through the practical demonstration of fundamental analysis for the Euro Pound, the USD CAD, and gold dollar forex pairs. I hope that you can apply these fundamental analysis to other currency pairs, to use this to understand the rationale behind picking a currency pair and the drivers behind it, so you know what to look out for and the strategy to employ when doing your fundamental analysis. See you in the next video.